CFA. Good afternoon. Thank you to the CFA Society in Spain for inviting us today, and to all of you for joining us this afternoon for the webinar, Commodities, a new bull run, how investing into commodities can help diversifying the portfolios and protect from inflation. Just a quick reminder that this session is being recorded, so it can be reflected on the CFA Society website. I am Rocío Poquet, Sales Manager at Aegon Asset Management, and I'm here today with my colleague Robert Mark, Lead Manager for the Commodity Funds since 2011. He joined Aegon Asset Management in 2006, and he's part of the multi-asset team headed the risk premium systematic strategic solutions. They are responsible for the asset allocation of more than 25 billion. RJ started his career as a quant analyst at Aegon Asset Management in 2006, where he was responsible for modeling and the research of all asset classes. Before joining Aegon, he obtained a master's in econometrics at the Erasmus University in Rotterdam, and he's also a CFA charter holder since 2010. Thank you for joining us today, RJ.
Hello. Yeah, I see that there is a message that the sound quality is poor, but can you hear me well? If you can give some feedback maybe on the chat. Okay, great. Thank you very much. Yeah, so well, thank you for the introduction, Roger. It's well, nice to be here, and hello all. And I think, well, based on your last question, so should we have commodities in our portfolio? I think, yeah, well, with recent events, but also the recent reflation scenario, it clearly has shown that commodities are a genuine diversifier and can protect the portfolio for adverse events. So also just looking at the markets right now, I've seen, well, equities, global equities moving down 12% year to date, European government bonds down 10%, European credit, European high yield, all down high single digit returns. And then looking at commodities, these are up, yeah, well, if I look at our fund, also 50% year to date. So that would have protected your portfolio in this environment. And well, I guess it has been a long time since we've all seen a proper high inflation period. The last time was in the 1970s, but in the 1970s, you actually saw the same thing that, well, commodities managed to, yeah, return annualized something like 15% a year and have a positive real return, while equities and bonds both had a negative real return over that whole period. So if you have a decade like that, then it's definitely interesting to be invested in commodities. So well, let's dive into the story for today.
Ajay, before we get started more with the presentation, as we were speaking earlier, we have seen that over the last few years, and as you mentioned earlier, like commodities have been in the focus of the market outlook, especially this year since last February, when the war exploded in Ukraine, and then all the oil and gas prices dumped. But sometimes when we think about commodities, as we can see on the screen, we think directly on oil and gas, and sometimes we are forgetting other commodities. Can you go a bit deeper into like which kind of commodities do we have in the world and what are the benefits from investing in them?
Yeah, sure. Yeah, so actually, I mean, yeah, oil and gas. So actually, if you look around in your own room at this moment, you see all kinds of materials and like wood, metals, but maybe also some food and drinks. Yeah, and all these are basically being generated and produced from basic inputs, which are commodities. So commodities are really all around us. And you can think about indeed next to the energy ones like copper, gold, but also wheat, corn, live cattle. So really everything which you use is produced from commodities. Well, maybe first let's have a look at commodities as an asset class, or if it is an asset class. And then moving to, yes, next slide. Because why would you invest in commodities altogether? So for one, it is a good inflation hedge. So we haven't seen much inflation for the last 2 decades, but yeah, at the moment, and also as said in the 1970s, in high inflation environments, it is almost the single hedge that you can have in the portfolio. Over the medium to long term, it provides attractive returns in your portfolio, and it also has good diversification benefits versus traditional building blocks like equities and bonds. So on the next slide, yeah, that's also shown. I mean, the slide over here shows the European inflation, and on the top right hand, you see the headline inflation in blue and the core inflation in yellow, the lines. And then the headline inflation is actually inflation you always see in the newspaper and what you actually experience in your own wallet if you're paying for something. And the core inflation is the inflation without energy and food. And what you then also see is that core inflation actually is quite stable over time, while most of the variation in the actual inflation, what you actually pay, is caused by food and energy. So having a larger allocation to these components, if you want to hedge for inflation, makes sense. And that's also shown in the table on the left-hand side, on the bottom left. It shows the breakdown of the inflation calculation, which shows that 58% is driven by goods of European inflation. And then within that, 16.7 plus 5.1, so about 23% is food driven and almost 10% energy driven. So altogether, that's almost 1/3 of your whole inflation bucket, which is driven by these commodities. So it then also makes sense intuitively that inflation and commodity prices are linked together. So if you want to hedge there, then this is the category you want to have.
Okay, before we jump into the next slide, we saw that commodities were amongst the best performing assets in 2021, and that they have been trading above historical average in 2022. So that has promoted a lot of interest, but if we see that related to the inflation, in theory, inflation destroys returns. What can you say about that?
Yeah, that's correct. So, I mean, of course, well, inflation is also a result of higher commodity prices. So maybe the relation is indeed also the other way around. But yeah, also if we look back, I mean, in 1970 till 1982, which is a 12-year period, you had a period of high and increasing inflation. And year over year, commodity prices were, yeah, the driver of that. So if you get stuck in an inflationary cycle like that, it can last for a long time. And that could mean that, well, now, of course, we have seen a couple of months of higher commodity returns, but these periods can persist for quite a long time in history.
Thank you.
Yeah, and then the second reason, so one is it's an inflation protection in your portfolio. Second reason is that it's an interesting diversifier in your portfolio. So this table shows the correlation of different asset classes, showing listed real estate, global equities, bonds, so fixed income and commodities. And then you see that the correlation of commodities over a very long term. So this runs from 1970 until last year. That the correlation is 19% with equities 0.3 and with fixed income near 0. So it also over the longer term provides a nice diversification over your portfolio. But also on the next slide, that adding it to the mix. So this is the obvious way of showing what it does to your portfolio. So just taking a plain vanilla cash, bond and equity portfolio, if you then add commodities to the mix with the diversification benefits in there, you can enhance the returns of your portfolio over the longer term. So it's not only a hedge, but also a nice addition over the medium to long term. But yeah, especially, of course, and that's what we've seen this year, in risk scenarios, it is the one category that can help you in these type of scenarios. So of course, with Russia invasion in Ukraine, the war over there, Russia is a big commodity player, of course, with a lot of energy, crude oil and natural gas. And then what you see around these type of events, of course, is that risk increases, most assets on financial markets lose value. And then actually one of the areas where you can protect yourself is commodities. And that's also shown on the right-hand side. We've shown the spot prices for European gas prices. I guess that everybody who had their energy contract expiring in the last few months experienced what happened, that prices really skyrocketed. And early March, the natural gas price in Europe, which is normally between, say, 20, 30 euros per megawatt hour. At some point in March, it hit 300 euros intraday. So that's 10 times the price within a matter of weeks. So if you indeed have clients that care for inflation protection, I guess that especially these type of assets in your portfolio can hedge you for, these kinds of large adverse effects over time.
And how can we invest in commodities? What type of instruments are there available?
Yeah, so let's start by saying that there are in the space there are a few large benchmarks that act as market standards. So the one shown here is the S&P GSCI. You also have the Bloomberg Commodity Index, which probably is also well known to people who are familiar with commodities. Well, at Aegon Asset Management, we use the S&P GSCI as our benchmark, and that's mainly because the difference between the two benchmarks is that the energy weight and the food weight is larger in the S&P GSCI because it's market volume weighted. And secondly, we think that as we have shown in the inflation breakdown, that most of the variation in inflation is driven by food and energy. It also makes sense if you want to use it as an inflation hedge to have a higher allocation there. So this slide shows all the different components. We break down the energy or the commodity universe in different sectors. So we have agriculture, energy, livestock, metals, and precious metals. And then also the different diagrams show the different underlying commodities which are in there. So it's all more familiar, well-known ones: aluminum, copper, nickel in the metal space. And we have feeder cattle, live cattle, for instance, in livestock, gold and silver and precious metals. And then in agriculture, corn, wheat, coffee, and also softs like cotton and stuff. Energy, crude oil, and natural gas, which are the most well-known ones. So, but there are different ways, and that's also shown on the next slide, on this slide. So, different ways to invest in commodities. So, of course, one is just by investing in equity of commodity companies. So, for instance, the big oil majors like Shell, BP, but also metals companies like Rio Tinto. But the drawback there is that if there is stress in the market and investors start selling their equity holdings, they don't care about having a certain energy company in their portfolio. They just go ahead and push the sell button and they sell everything. So these companies do have a equity beta attached to them. And secondly, you also have idiosyncratic risks. So if I think about BP, British Petroleum, in 2010, you had the big oil spill in the Gulf of Mexico. The oil price actually moved up slightly, but the stock went down massively on the back of that event. So if you actually want the exposure, then you probably don't want to have that through the equities because there's many other risks attached there. Then the second way of investing is just physical trade. So just going to the harbor, buying some barrels of oil, going to the country and buying some cows. But that's very labor intensive. And you have a big logistical process attached to that. So not really doable for most investment companies. And then third, you can invest via futures and swaps. And the nice thing there is that it's standardized, it's no logistical process, easy to trade, high liquidity. But you do have to think about the term premium, which is a feature there. because you're not trading in the spot market. And that's also what most investors and also we prefer to use futures and swaps. And on the next slide, yeah, a bit of the specifics. I guess that everybody who done their CFA know these instruments. But just to recap, so futures are exchange traded with fixed specifications. So if you trade one future on oil, you trade on 1,000 barrels with a fixed expiration date and a 1-month delivery. But note that some of these futures contracts do have delivery risk. So if you forget to sell it before expiration and roll it into the next contract, you could receive a phone call from some company saying, hey, I have your 1,000 barrels of oil standing here, and you need to pick them up. Yeah, and then on the other hand, swaps, which are OTC, more flexible. So you can just do it on an underlying commodity or a basket of commodities. Just state any quantity or notional you want. And also the expiration date is flexible. So it's all a bit easier to handle and less, trading heavy. And I think the best add-on is that there is no delivery risk. So it's always cash settled. So that also reduces operational risks. And that's also how we do it, trading most of the exposure in swaps. And then I think next, something very specific to the commodity market is that you also have to account for limit moves. And that is that the regulator for the most primary goods like wheat, so the foods and such have introduced limit moves. So that means that, for instance, in this example, wheat has a limit of 60 cents. So if the trading moves more than 60 cents on one day, the trading stops, no matter if it's within 1 minute of trading, they just stop trading, send everybody home to think about it, and then resume trading the next day. And that is really to avoid and to limit speculative trading, because these commodities are also quite sensitive to the public. So if you're buying your bread in the shop and you pay €1 and the next day you have to pay 100, and people panic, and the regulators and the governments don't want that. So that's why they have this cooling down mechanism built in, that prices cannot rise too much on a day-to-day basis.
This mechanism is being used right now because the commodity prices keep raising every day. And in Spain, when you watch the news, it's about how the price of the electricity is going up and up. And I think it's more than $6 a day. So we will see.
Yeah, so the return driver. So commodities have a variety, or have 3 actually return drivers. It's also shown on the next slide, and that is one, the spot return. So driven by supply and demand, just on the market, what you're paying for your barrel of oil, or for your bar of gold, or for your cow, just on the market. Then secondly, because if you invest in a derivative in future on a swap, you don't have to actually invest the cash. You just post a margin, you keep the cash. So you also have a cash return, which is on a deposit or on a short-term money market instrument. And then third, you also have the roll return. And the roll return is that you buy a future, and then at some point before maturity, you have to sell that future again and roll it into the next future. Otherwise, you will get the underlying commodity delivered. But the price of these futures do not necessarily have to be the same. So there is some storage and insurance cost embedded in there, interest rate cost. It depends on inventory levels. But there's also a convenience yield there because the producer can transfer the price risk to the investor over a certain time period. So if there is an oil company who knows that they are going to pump oil in August, they already want to fix the price for that at this moment, and they can sell a future for August, and that gives them less price risk. So the investor can be compensated for that. And maybe to show how that works on the next slide, indeed, a future curve, and this is the future curve of copper. And what you then see indeed is that at the front of the curve. So for, well, this was April 22 delivery. The price of copper was above $10,000 per megaton. But then if you look 1 year out, trading a copper future in 2023, April 2023, you would pay less than $10,000 per megaton. So a cheaper price. So that also tells you that it could be, if you are buying copper and you don't need it for now, but maybe some point in the future, if the curve is downward sloping and price go down, that you would invest maybe at a later point in time to to capture that that premium that you then get, or that positive price difference. Yeah, on the next slide, these curves can have different shapes. So on the top, curve is downward sloping, so future contracts are priced lower than the spot contract, meaning that if you buy it for a future date, price doesn't move. You just roll up the curve and can then sell it for a higher price, so have positive return. So the roll yield then is positive, and that's called that the curve is in backwardation. And then if the curve is upward sloping, then future prices are higher than the current price. So if then the price doesn't change and you have bought a future contract to roll down the curve, having a negative return, and that's in contango. But these are not the only shapes you have in the commodity market, because you also have seasonality effects. So this is the future curve of natural gas, where you see every year a spike of prices in the winter. And that also makes sense because in the winter it's cold, everybody uses gas. And then especially companies want to ensure that they have their gas delivery guaranteed. So they're willing to pay a hefty premium for that. But then again, if you're a capital provider, if you're an investor, you could provide that capital, get that premium in, and then if there is a milder winter and prices do not spike, you get that premium. You can just collect that premium. And also what's shown here, if you look at prices between the two red circles, then you see that well, prices are in the summer months around $20 or $2.60, and then in the winter months around $3. So there's well, almost 15–16% risk premia there, which you can capture if you are, and feel comfortable trading that that premium.
Can we explain the returns of the commodity markets over the last few decades?
Sorry, I didn't get that question.
How can we explain the returns of the commodity markets over the last few decades?
Yeah, so so if I have that on the next slide. Sorry. So if you look across the different time periods, then I've allocated them in different segments of time. So looking at the 70s till 1981, I said, that was the great inflation of the 70s period. And you saw that US CPI averaged around 8%. At that time, commodities performed very well. And then you see that there's a 6% price return, there's a 1.4% positive raw return, and also a strong cash return of 8%. Bringing you a total of almost 16% return annualized in commodities. And then the decades after, so you had 1982 till 2008, you had a deregulation and globalization period where inflation drifted lower. So US CPI around 3%, and you already see that, well, the price return is still positive, around 2%, but the raw return almost zero, and cash return 5.5%. And then especially the period after that, so after the Great Recession and the low inflation period where everybody was worried about deflation, central banks also acting on that. You saw in that period that commodities did not perform well, but I think that most investors really look at the price. And if you would only have looked at spot price on an annual basis, we're still giving you a positive return, 1.3% annualized. So not high, but also not too low, not negative. But then the roll return, because the curves all flipped into a strong contango, the roll return was very strongly negative. And that's also what caused a long trend of, more negative returns the last decade for commodities. Also aligning with that inflation number, because inflation, and then also a negative return. And then I think, well, the interesting part is the last part, of course, the 2021 starting the reflation era, or at least a period again of high inflation. We see US CPI averaging in that period actually exactly the same as we saw in that 1970s whole decade period, 7.9%. And again, we see commodities doing very well. So that also tells you that, if you expect a scenario for the next few years where inflation will remain high, then, this will definitely be a category that's expected to do well on the back of that. And then maybe indeed to highlight, the negative roll return in the last decade. Well, we had a couple of events there which caused that, and I think it was mainly caused by the oil price, and that started really indeed in 2009 with the oil glut. So we had the Great Recession starting after the credit crunch, and then economic activity dropped down quite heavily, and then the oil glut caused oil prices to plummet. So spot prices moving from around $150 even in 2008. 45 quite quickly in 2009, but the long end of the curve did not move that much. So as shown on the graph on the left, there was a $16 difference between the July 2009 contract and the contract 1 year out. So that's $16 on a $45 spot. So that's a minus 33% roll down. So that's immense on your position. And if you have a roll down like that for a while, then that really hurts your overall roll yields. And then next to that, we also had a second event in 2014 with the US shale companies emerging and increasing their oil production. You had another of these type of events with a negative roll yield. And that really caused that roll yield over the decade to be that negative, these type of, or these unique events actually. But it's not a one-time incident. So on April 2020, when Corona hit, we had another event where economic activity completely stopped, and you saw another big contango in the market. But then again, now with the economy restarted, I mean, that was 2 years ago, 2 years later, and the picture is completely opposite. So now, as recent as March 8, oil prices hit $130. And then the roll yield was $30 positive. So you had a positive roll yield of around 30% in there. So you have to be, if you want to invest in this market, you do probably want to have somebody who has expertise, know how to read these curves and follow these on a daily basis, because the roll yield is an important return component in your overall return. You can just not only look at spot prices, you have to look at the whole dynamic of the markets to be able to capture these returns.
Okay, you have mentioned that the return of commodities has overperformed over the last few years. How can we obtain that excess return in the commodity market, and what are the opportunities that this asset class is representing?
Yeah, so there are various ways to generate excess returns also in this market, and that is one is by the beta positioning, so increasing your beta above 1 or below 1. The sectors are also not only fundamentally but also return-wise very diversifying amongst themselves. So also by taking position between sectors and also between single commodities. And I think something, and that's something we also do a lot, is across the curve. So looking at the backwardation slash contango profile of different commodities versus each other, and also the seasonality effects, where the risk premias are within the curves, and trying to capture these. And maybe moving to that first point, so the beta positioning. And that's also what I've shown in the table of the different returns, is that well, in certain phases and certain cycles of the economy, commodities perform very well. And that's also what you see. So over here we show the economic cycle, and then below each cycle, the return of different asset classes within these parts of the cycle. So phase one, so the recessionary phase, you actually see that commodities do quite well. And that is a result of that, especially in the last phase of the economy, the overheating phase, everything and all the factories start to run at full capacity. All the inputs are used to the max, and then commodity prices, but also wages are rising. But that effect lasts longer than just the phase of that overheating. So you also see still in the beginning of actually when the economy already starts to cool off, you still see commodities doing quite well, while most other asset classes don't perform very well. And that's actually comparable to what you see now, that, well, we have headlines yesterday already of the Bank of England that they said that economic activity was decreasing. You see that equity prices go down, you see that bond prices go down, and commodity prices actually still going up. So you actually see an example of that at the moment. While commodities in the recovery and expansion phase don't typically tend to do that well. And that's just because, well, the economy has just been in recession. There's still plenty of capacity left. Capacity utilization is low. So you then see that equities, which are ahead of the curve, start doing well usually, while commodities are typically lagging. So also in this profile, you see the nice diversification effects that you have from having a bit of commodities in your portfolio. That will balance a bit of your and dampen a bit of your return profile, especially in these recessionary, but also in these overheating phases. Then secondly, between sectors, and I guess that, yeah, also intuitively that makes sense that, well, as said, if the economy is overheating and everything is going at full steam ahead, you have the more industrial commodities which tend to do well. So energy is then needed, but also metals. You see that food, for instance, and agriculture have a completely different profile because, yeah, these are not really linked to the economic cycle. If the economic cycle is doing well, you're not going to eat twice as much. But these are more dependent on seasonal effects and weather effects. And well, also now as we see on if certain, if there is a risk event like the invasion in Ukraine, where there's a lot of wheat being produced, if a country like that is invaded, then there's also a price effect for agriculture. And then you also have precious metals, which are more a safe haven. So they all have their own dynamics and their own characteristics, which also diversify across themselves, and you can just play with that and enhance your returns by changing your allocations on the back of that. And then next slide, yeah. Yeah, also between curves. So in this graph on the right, I show the WTI crude and Brent crude oil future curves. And this was in 2019. But then the interesting thing is it's both crude oil. So you would expect that these prices are completely correlated. And they are 99.9% correlated. But sometimes there are interesting differences between the curves of both of these commodities. So back in 2019, you had the front end of the curve of WTI being in contango, and you had a negative raw yield of -4% on an annual basis, while the Brent crude curve was in backwardation. You had a positive carry of 8.8% annualized. So by just overweighting Brent a bit and underweighting WTI a bit in your portfolio, you could increase or enhance your carry profile and generate a positive implied carry in the portfolio. So these type of things. So we look, that's also what we do, looking across different commodities in the portfolio which are correlated, and then changing the allocations towards the more attractive carry profiles and also attractive contracts that we can find.
And are they, with all of this in mind, what are the main characteristics of the strategy Aegon Commodity Fund? And how is the strategy allocated, and what are the primary sources of return?
Yeah. So yeah, so that's also shown in this is actually our positioning versus the benchmark. It's a while back, but also showing what I just said. So we had an overweight in the commodities within sectors which are a bit more in backwardation, so generating a more positive raw return than the commodities which are typically more contangoed. So that led to an overweight in Brent, as also shown in the previous graph back then, versus WTI natural gas, which is especially natural gas, which is typically in a strong contango. And then within the metal space, an overweight in copper versus the other metals, and then in agriculture, soybeans and sugar overweights versus the other commodities, and in livestock, a live cattle overweight. And that then leads that your overall, and that's on the right shown, that your overall tilt towards backwardation is slightly more attractive than the benchmark. And in that way, you can enhance the benchmark returns over time and generate positive returns.
You have mentioned earlier how the market has been performing over time, and you have specifically mentioned 2009 as an example. If we compare our strategy to the market, how has it been performing since inception? What are the main benefits of the strategy you manage?
Yeah, so yeah, let me start by saying that, well, we have almost 700 million euro in direct commodity funds as assets under management. And then also assets across different other propositions that we manage. So in total, that accounts to more than 1 billion in assets that we have across different vehicles in commodity investments. And then maybe moving to slide 33. So that's maybe the next one even maybe captured it even better. That shows the annual returns for each year since we started the fund in 2009. And also the excess return on the bottom row. And we actually managed to achieve an outperformance in every single year except 2014, but in every other year we managed to managed to get an outperformance in the fund, which in total on average over the whole period is almost 1.4% added versus the benchmark on an average basis. So yeah, that shows us, and this profile also shows that it is not a one-off. It is quite a consistent outperformance, and also that, well, the strategies that we use generates that structural performance for us, and we have been showing that over the last 12 years, and that also gives us confidence that we will we'll be able to keep doing that. And that's all.
Thank you for this thorough explanation of the commodity market, RJ. If we had to summarize the presentation in a few key ideas, what would it be?
Yeah, I think for one, so key points are that commodities are a diversifying asset class, that it can provide attractive returns for your investment portfolio over the medium to long run, and especially in an environment with reflation or higher inflation or extreme events where traditional asset classes are vulnerable and tend to achieve negative real returns, then commodities can really protect your portfolio and give you these attractive returns that you're looking for as an investor. And it has been an asset class that has been out of favor in the last decade. And I mean, seeing the low inflation and the deflation fears, that's also something you can expect in such a in such a period. But yeah, I mean, now for the last 2.5 years, we have seen reflation returning. And as we've seen in the 70s, that can persist for more than a decade. So if that's also something that, yeah, that you're worried about or your investors are worried about, and I think considering adding a bit of commodity exposure to the portfolio definitely makes sense. And then, as also explained, just relying on your equity commodity holdings, do not cut it, because these are usually quite correlated to the equity market. So you really need to yeah, add to some real commodity exposure, I guess, to the portfolio. I guess that's it.
Thank you very much for your time. And now we are open to any questions you might have. You can post them on the chat if you want. So RJ will be delighted to answer them. RJ, wanted to ask you, like, what is the current market outlook for the next few months? Because I think there's a lot of uncertainty regarding the war, and Europe is trying to find alternative sources of gas from Ukraine, and I think it's like from the interest of everyone to see what are the market perspective. Is this like a seasonal trend for the next upcoming months, or is like the increase in the price of the commodity gonna last not forever, but at least for a long period of time?
Yeah, so I think that at the moment, of course, with the war in Ukraine ongoing, I think that the biggest risk event, of course, is that other countries will get involved. That would be a clear risk, and then price would spike even harder. But even if that doesn't happen, and if the whole conflict stabilizes or maybe even gets to a solution, these sanctions will persist for a while. These will not be taken away immediately, because a lot of harm has been done. So that means that a lot of commodities, especially gas and oil, needs to be, and gas is impossible because there's no pipelines available for Russia to export that anywhere else. But also for oil, then there needs to be rerouting, which brings a lot of logistical cost. So for the near term, it is expected that prices will remain elevated, or even could move a bit higher if some of these risk scenarios evolve and there is escalation in the whole conflict.
Then, like, we are seeing an increasing trend of sustainable investment, and we see that there's like potential high returns in commodities. I think that is the worry of everyone that is managing portfolios, to see how commodities can fit into a sustainable portfolio, because at the end, we are in that mix of, I don't want to invest in oil and gas companies because they are from the excluded sectors. However, I have high potential returns. How does it fit together?
Yeah, so that's also something that we are actually looking at the moment. And I think that, well, at the moment, of course, the world is on a path towards carbon neutral, but we cannot get there overnight. So I think that, and that's also something we are looking at in our commodity investments, if you can have a like glide path or a multi-step change towards a sustainable solution. And I mean, renewable energy and these type of sources, they are becoming available, but they are not widely available, not liquid to trade yet. And also not, I mean, still the biggest source. So we need to work towards that. And I think on the path towards that sustainability, at the moment, there is still room for these type of investments in the portfolio, and they will phase out at some point and move to the more renewable solutions, but that will take a bit of time. And we are also looking at the path at the moment. It's not something we have already concluded on, but it's definitely a high priority on our list.
So will then the sources of renewable energy become commodities, such as like water and wind, since they are like the sources of like other renewable energy, maybe in like a few years' time, water and wind are like considered commodities, and we are trading on the price of something, and we start speculating.
Yes, exactly. So what you would need is standardization in prices for these type of energy sources. So at the moment you don't have that yet, but there are big players who are working on turning wind energy into hydroelectric power. And at that point you could also store it, and then you could start trading it. But yeah, these things are quite far in the distance. But then if you get that standardization, and that will happen, right? If the largest share of the energy will be produced in that way, then at some point that will happen. You will get that standardization, and then the move towards a real sustainable solution on the commodity side will also happen. But as said, at this point, the world is not ready for that yet. We are working towards that, and it's definitely high on the agenda.
Thank you very much for your time, RJ, and thank you all very much for your time and connecting to the webinar this afternoon. It was a pleasure to be with the CFA Society this afternoon, and please do let us know and reach out to us if you have any further questions. Thank you very much.
Thank you very much.